Now, when it comes down to it, we have to look at evaluating an investment for the company and that sort of thing, whether it's in a truck or warehouse, wherever the case is. The weighted average cost of capital is just the starting point, okay? Because we have to evaluate whether we're going to get more money return just right off the face of it, okay? Other methods involve detailed cash flow analysis, and some of them involve timings of these cash flows, and then some are just quick, down, and dirty. And we're going to have a quick look at those. So a 2005 survey found that SME owners, i.e. small to medium enterprise size companies, decided on an investment like this. 26% of the time they used gut feel, so that was number one in the research. Payback period was 19%. Accounting rate of return was 14%. Interesting. Net present value and internal rate of return were 12%. Now that's actually a variation of each other. They're kind of the same thing. And a combination of the four was used 11% of the time. The more education the owner had, the more likely she was to use last two. So net present value and internal rate of return, and or combination of one of the above and the usually number 4. Interesting. Now, the payback period, internal rate of return, and the net present value are all fairly commonly used, and they involve some Excel spreadsheets and that sort of thing, except for the payback period. We're not going to look at average accounting return, which I find in that survey is kind of interesting because a fair number of people use it, but at the same time, I don't think it's very reliable for small business, and it's a little bit complicated and all that fun stuff. We've got some very powerful tools in the first couple of analysis here without really diving into that. So we're going to have a look at those a little more closely. The payback period is a fairly simple concept, okay? Basically, it's something a lot of owners just use off the top of their head and say, okay, if we're going to do this enterprise, I want my money back in 12 months. So just pick a number. That's just basically what it says here, arbitrarily established. Advantage, it's easy to use. Another one of those quick and dirty approaches. It's leaning towards or emphasizes liquidity. So I'll get my money back quickly. That's basically calling it a current account if I use the 12-month rule or payback period. Also a measure of the risk of the investment, because if you want the payback period to be shorter, i.e. you get your money back quicker, then that implies there's a bit of a risk. Okay, and sometimes it can be used as a goal as well. So not a bad piece of work there either. Now, like all quick and dirty approaches, it does have some drawbacks. It ignores the inflows after the cutoff period, and kind of yes and kind of no. Basically says I get my money back after 12 months, then we're free and clear. So you could stand to make even more money in the second year than you would have in the first. It might be one of those developments or decisions that takes time to really start kicking in some money, which may, if you just strictly stick to the payback period, it may lead you not to invest in something that might be more profitable long run. So that's something to have to think about. Just about every payback period that I've seen used doesn't consider the time value of money. And you took that in the business math course, so I don't really have to explain that too much, the time value of money. Just say, conceptually, our money's worth less down the road, and if we're paying interest on it, it's worth even less, etc., etc., etc. Doesn't appear to have an objective yardstick, and I used to have a boss whose payback period would change depending on what kind of a mood he was in. So yeah, that can be true. And some people just use it as a flat sort of ruler, which might not be a good measure of risk. Okay, so it might be if you apply that to all the decisions in the company, then you're really not saying, okay, this move or this investment's a little riskier than that investment. So we have to kind of think about that too. A lot of the calculation, by the way, the flat number calculations don't measure risk either. So I could apply this disadvantage to just about everything. So we have to be careful with that. I have seen variations on this, a discounted payback, and it does allow for the time value of money, but then, of course, it's not down and dirty anymore, is it? So I kind of have to laugh at some of the definitions we come up with in real life and in textbooks. Okay, internal rate of return, slightly different. You plug in all of the cash flows into the table, and Excel calculates the return. Okay, so that's kind of interesting. And if it's above 0, then it's something you want to do, and if it's below 0, it's something you don't want to do. It doesn't actually tell you how much the return is. It just gives you a 0 point, kind of like a pass-fail grade. There's also another one coming out that was just starting to come out when the 2005 survey was done, something called EVA, or Economic Value Added to the company. The idea is that sometimes doing something is better than doing nothing at all, and you have to look at the actual amount of profit added to the company above and beyond what might happen. And the thinking here is that, given all the alternatives, maybe it's a better investment to do. It's better, of course, to actually do something that brings money into the company, and sometimes the rates of return and all that sort of thing don't match up. It's a little complicated. It was actually begun by my professor at Queen's, who actually initiated this whole concept. And we're seeing more and more of it at this point in time. It's not widely used, but if you feel the urge to use it, it's findable on Wikipedia, and away you go.